Welcome to Focus on Liberia. We are dedicated to educating, elevating, and promoting all things Liberia. Today, we are not looking at aspirations. We are looking at the hard reality of the numbers. We're analyzing three data sets too critically. Assess where the nation's money has been, where it's going, and why so little of it is truly invested in the human and material conditions of the Liberian people. We're pointing out the flaws in the system that continue to prioritize the state over the citizen. Let's dive into the structural weaknesses exposed by the data. The flaw of fiscal fragility to 0102-016. Our first analysis is a historical look at Liberia's budget shortfalls between 2010 and 2016. This data doesn't just show volatility. It exposes a structural inability to withstand shocks. For years, the country operated with persistent deficits, from minus 3.8% in 2011 to minus 5.0% in 2013. But the system shattered in 2015. The deficit didn't just grow, it exploded to minus 8.4% of GDP, resulting in a devastating $370 million shortfall. This record high isn't just a bad number. It is a monument to the lack of fiscal shock absorbers. That massive shortfall exposed millions of Liberians to hardship because the government lacked the reserves or the economic diversity to cope with a crisis like an epidemic or a commodity price crash. It speaks volumes about the vulnerability of the national economy and the immediate material suffering such fiscal fragility causes. The so-called correction in 2016, where the deficit improved to minus 5.5%, is still worse than the 2010 starting point. This confirms that the nation's fiscal baseline remains deeply unstable and fundamentally fragile. The flaw of underinvestment and debt drain. The 2026 national budget may turn now to the highest level data, the $1.211 billion national budget for 2026, where the fundamental flaw of prioritizing the state machine over the human condition is most glaring. Look at the structure. Recurrent expenditure, $929.6 million, 76.7%. This is the cost of running the government: salaries, fuel, and office utilities. Public sector investment plan, $281.5 million, 23.2%. This is the money for new roads, new hospitals, new schools, actual material investment in the country's future. Nearly 3/4 of the budget is spent simply operating the state, leaving barely a quarter for true capital investment. This is a maintenance budget, not a development budget. The $200 million ArcelorMittal signature bonus being fully allocated to public sector investment plan simply masks this structural weakness, temporarily inflating the investment number without fixing the underlying systemic imbalance. Now, let's look at the critical sector allocations. The priorities are startling. Security and rule of law is allocated $151 million. Health receives a meager $101 million. Education gets only $123 million. The budget invests more in controlling the population than in developing its mind and body. The most egregious example is agriculture, the backbone for the vast majority of Liberian livelihoods, which is allocated a paltry $13 million. How can we expect to empower our farmers, create food security, or drive rural economic growth with such a minimal commitment? Finally, the crushing burden of debt. The allocation for debt service in 2026 is $230 million. This is money that must be paid to service past failures. Crucially, this is $230 million. This is money that must be paid to service past failures. Crucially, this $230 million is nearly equal to the entire public sector investment plan of $281 million. The money required to pay for the mistakes of the past is consuming almost as much as the money allocated to build the future. This debt drain is the single greatest obstacle to improving the material conditions of the people. The data is clear. Liberia's fiscal landscape is characterized by historical fragility, institutional stagnation, and a structural budget that prioritizes operating costs and debt repayment over strategic investments in its citizens. The budget is not a statement of national aspiration. It is an indictment of national priorities. We must demand an end to this cycle: greater investment in health, education, and agriculture, a fundamental restructuring of the debt, and a commitment To utilizing the full human capital of the nation, regardless of gender, we must continue to educate, elevate, and most importantly, hold the system accountable. This has been emphasis on Liberia.